started. All right, continuing chapter 16 here. The T formula, the cap rates, you could use the T formula to calculate the cap rates, and you use the reverse T formula. T formula can be used for a lot of things, cap rates, commissions, a lot of things. But the reverse T formula here, the only thing it works for is calculating the GRM, the gross rent multiplier, which is a number that's used to compare. You come up with this number, and then it's used to compare two properties. You could use it to compare a 3-unit building to another 3-unit building, a 4-unit building to another 4-unit building. You can't compare a 2-unit building to a 3-unit building. Okay, it has to be the same number of units. You got to be comparing similar types of properties here. All right, otherwise it doesn't work. So using the income approach to value, it's based on the present worth of the future rights to the income on the property. So it's used for valuing any property that generates income using one of these two methods, cap rates or GRM. So cap rate is more accurate, of course, because you have all the numbers for that particular property. GRM is when you don't have all the numbers, all the income expenses for that property, and you got to guesstimate to figure it out. Or you have a number for another property that's similar. You could come up with the GRM for that property and apply it to the similar property with the same amount of units to come up with the value. So let's take a look at this. Cap rates, also known as capitalization rates. It's a measurement that determines the rate of return on investors' money. So we use the T formula to calculate it using one of these. You have to have two of the three items below to figure it out using the T formula. The annual net operating income, the value of the property, or the cap rate itself. Have any of these two numbers, and you could figure out the third one using that T formula. And to calculate the net, you need to take the gross operating income, that's your annual income before expenses, subtract the gross operating expenses, the annual expenses, not counting the mortgage loans, because that would be different for different owners. And then you get the net. So you subtract the expenses from the income, you get the net. Make sure it's annual. And then we got the gross rent multiplier we're going to learn about, the GRM. So the GRM is used to determine the value by comparing two or more similar properties, a 4-unit to a 4-unit, a 3-unit to a 3-unit, a 5-unit to a 5-unit, using a whole number. The GRM is not a percentage or a rate. It is a multiplier. It's a whole number, which the number itself is insignificant. There's no good or bad GRM. It's just a number that's applied to a property, and then you could use it to compare it to another in an area. So you're going to use the reverse T formula where the large number goes up top instead of on the bottom. That large number is the value of the property. And then you have the gross monthly income on the bottom. That's a small number. Whereas the small number for calculating cap rates would be the annual net income. Okay, we're using the gross monthly income. Okay. And then the GIM, the gross income multiplier, is kind of like a spin-off of the GRM. It also includes income from non-real estate sources, like revenue from concession stands. So highlight and take these notes here. This is the reverse T formula, like I showed you on a previous slide. Remember, TGIF, top number goes in the calculator first. That's what that stands for. This is the reverse T formula where the property value goes up top, gross monthly income on the bottom, and the GRM, which is not a percentage, on the other side. Now, when they say similar properties, what does that mean? It means you compare a 3-unit building to a 3-unit, a 4-unit to a 4-unit. Okay? It will not work by comparing a 3-unit building to a 4-unit building. It just won't work. So The gross rent multiplier relates the sales price of a property to its rental income. Let me know when you guys got those notes.
1 second. Gross rent multiplier. There we go. So in GRM, sales price goes up, income goes down. Okay. Should we write it down, that thing? Of course, right?
Yeah, it's good to have it there, right there in your book, right where they're talking about the GRM.
Mm-hmm.
On the previous page, you wrote cap rate. You wrote the T formula next to the cap rates, how to calculate it.
Yeah.
So on this side, we're just writing the reverse T formula. At least that's what I call it. I call it reverse because it's reverse where the top number, where the large number goes.
Mm.
Now, the small number is completely different, but it's reverse where the top number goes. Or the large number goes on top.
In reverse.
In the reverse T formula, correct. The only thing different is what the small number is. In this case, it's gross monthly income, whereas in cap rates, it was the net annual income.
Multiply. And T formula. Enter. And for GRM, sales price goes up and a rental income down, right?
What do you mean up and goes up? On top, you
G
mean? You mean on top?
Sales price on top. Yeah.
Yeah, on top. Yeah.
That's a simple one. You don't have to have T. There is no T formula, only T formula for the reverse. And this one is simple. Sales price divide in rental income.
What don't you have a T formula for? I'm
For
sorry.
reverse.
No, it's the reverse T formula. Yeah, so
Reverse.
you have the T
Mm.
formula for cap rates and the reverse T formula for the gross rent multiplier, where the property value goes up top, gross monthly income on one side, and the GRM, that gross rent multiplier, on the other side, which it is not a percentage, so you got to remember that so you don't hit the percent button there. Um, and then you calculate it. All right, so you got the notes on that?
Mm-hmm.
We'll do math problems on this stuff in a little while. I just want all the notes down first. Okay. Um, okay, well, so once again, here's the two formulas. All right. And so before we get into the math, we're going to finish up the terminology here in this chapter. Reconciliation is when an appraiser uses more than one of the three approaches to value. They apply more than one of the three approaches to value to the same property. It's called reconciliation. And that's what an appraiser usually does. They try to apply all the approaches to value on the property, and whichever one is the most valuable, that's the one they use. So, or most profitable, that's the one they use. So we have the sales comparison approach, we have the cost approach, and the income approach. So reconciliation is when you apply more than one of the three approaches to value to the same property. So let's highlight that. Page 316. If more than one of the three approaches to value are applied to the same property, it's called reconciliation. Add that to your definition list right there. What is reconciliation?
Yeah.
All right. So the appraiser tries to apply all three approaches to value to the same property, and then they use the more valuable one.
Okay.
Well, some approaches to value, like they say, cannot be really used accurately on every property. Like they give an example, appraising a home using the income approach is rarely used, and the cost approach is of limited value unless the home is relatively new. Therefore, the sales comparison approach gives the greatest weight in valuing a single family residence, for example. So once again, T formula, top number goes in first, small number on top, large number on one side, percentage or rate on the other, unless you're calculating gross rent multiplier, where the large number would go on top and the small number goes on the bottom. And this side would not be a rate, it would just be a whole number. Remember, here is your typical T formula for calculating cap rates, commissions, interest, taxes, profit losses. Okay, so these are the different types of things you could use the regular T formula for calculating. All right. So let's do a problem here. Here's the problem on the right-hand side. If you charge the seller, because this would just be in sentence format, that's the way that you would get it. There was no, they wouldn't give you the graphic for the T formula. That's a tool that I'm teaching you to remember. You just draw the T, you put the division sign up top here and a multiplication down the bottom, divide down, multiply across to figure out the missing component. So in this case, if you charge the seller 6%, where does that percent go? Down the bottom. And the total commission collected was $21,600. How much did the property sell for? Well, we know that the sale price is going to be more than the commission, so commission's the smaller number, so that goes up top. Now we take the small number divided by the large number, or the percentage in this case, to figure out the large number, what the sale price was. So what do you get? 21,600 divided by 6%.
160.
There you go, 360. Right? And you could prove your math this way too. You could take 21,600 divided by 360, you should get 6%. Or take 360 times 6%, you should get 21,600. It's a way to prove the math too. All right, here's another problem for you. Using the same house, I guess. If a house sold for 360 and the agent charged 6% commission, how much would the total commission be? 360 times 6%, 21.6.
Yeah, that's we had.
Right. All right. So now let's use this to calculate a cap rate. So the question is, if a property sells for 400,000 with 3 units that rent for $1,200 a month each, with the following expenses, what would the cap rate be? And they give you property taxes, $8,500 a year. So what you got to do is, some of these expenses are monthly, some are quarterly, some are annually. So you got to convert them all to annual and then just add them up. So that's the easiest way to calculate all your expenses. So you got your property taxes, insurance, water, sewer, electric, gas, trash, waste removal, landscapers, miscellaneous repairs, mortgage payments. Well, we know the mortgage payments we don't use. That's a trick. That's why I put that in there. Don't use that. Okay. So any numbers we could plug in here now in this T formula to figure out what the cap rate on this property is?
Yeah, big number is gonna go up.
Which one's the big number?
400,000.
Wait, that goes where? To
On
figure
top.
out the cap rate?
Cap rate. You're
Well,
using
Four-
the T-
400,000.
yeah, but
Oh, on the left.
you're using the T formula or the reverse T formula for cap rates?
Ooh, yeah. For cap rate is
The GRM uses the reverse T formula. It's the only problem that uses the reverse T formula is the GRM. So here we're trying to figure out the cap rate, so we're using the regular T formula. So that
a
case,
small
the
number.
large
Small
number goes
number.
on the bottom.
Bottom, yeah,
The
left
number
side.
goes on bottom.
Yeah.
Okay. So any other numbers we could plug in? Well, we need to calculate what the NOI is to plug it in here. So how do you calculate the NOI, the net operating income? How's that?
Minus
What do you got to do?
net operating income minus.
No. How do you calculate the net operating income?
Yeah. Okay.
Multiply 1,200 by 3 by 12.
Okay, that'll give you that monthly income. If it's got 3 units, rented for 1,200 a month each,
Mhm.
1,200 times 3, that gives you your monthly income. The net,
36.
okay, so, 3,600. Now monthly, what is it annually?
43,200.
Okay, and then to calculate the net, what do we need to do with that income? We need to calculate all the expenses, because what is the net?
Expensive.
Expenses minus the income annually. So you take your annual income here. Here's that formula for you.
GOI.
The GOI is $43,200, right? Now we need to figure out the expenses by adding up all the expenses, except for the debt services, the mortgage. So we gotta. I already converted them all to annual figures here, and it comes out to
8,500
$16,560. Okay. So 16,560, the expenses minus the income gives you a net of $26,640. That's not bad for fairly passive income as a landlord. All you're doing is renting out the property and you're netting $26,640 a year. I say passive income, but I said fairly passive income because there are some
operating
work
income.
involved that you need to do on the property, maybe cutting the grass and snow removal, or unless you're hiring somebody to do all that stuff, but you got to deal with tenants. So what numbers do we plug in where to figure out this T formula?
In the top,
Sorry, what numbers do we plug in where?
26640 and
26,640 in the top,
Okay, and then
and 400,000 in the left under.
okay, so 26,640 divided by 400.
Yeah. And then you divide it.
We get a 6.6% cap rate, right? You put this one in the calculator first, then you hit the division symbol, and then you put this one. You work your way down. TGIF, top number, goes in the calculator first. And you get a 6.6% cap rate on this property. So this investor is earning 6.6% income on their money that they invested in this property.
So this T calculation, how you call this T?
T
For
formula. Just a T formula.
no reverse, for no reverse.
No, the reverse T formula is one where the large number goes up top and the small gross monthly income goes on the bottom to calculate the GRM, the gross rent multiplier.
Yeah, that's well confused. Yeah, that's not reverse. Okay.
Yeah. No, this is the regular T formula to calculate cap rates. Calculate cap rates, commissions, things like that. You use the T formula. The GRM, the only thing you use the reverse T formula for is for calculating the GRM. It's the only problem.
excuse me, GOI. We got 4,300 to 43,100, 200, right? 4,320. That's gross income
That's
monthly. times 12 months?
No, that's not the monthly. The monthly is you got $1,200 a month for each unit. You have 3 units. So 1,200 times 3
3,600.
times 12 months,
Okay.
and you get the GOI.
Okay, got it now. Okay.
Okay. And then for the expenses, we just converted all the quarterly expenses, yearly expenses, monthly expenses. We converted everything to annual, and then we just added them up. And then we subtract the expenses from the income, and you get the net.
So
Remember,
1,200 times 3.
yeah, do not calculate the financing, the mortgage loan, into the expenses. Now, if you're your own owner and you're not selling the property and you just want to know what your true return on your investment is, you could calculate that in. But when trying to sell the property, we do not calculate the mortgage payments because people pay different prices, have different mortgage amounts.
Yeah.
It'll be different for everybody. So you don't calculate that into the cap rate when trying to figure out the cap rate.
Got it.
Okay, so here's another one. Let's see. Calculating the GRM for that same problem on the previous slide where we had the value was 400,000 and the gross monthly income was 3,600. So what is the GRM for the example we just figured with that 6.6% cap rate that we got for that property? Now let's try to figure out what the GRM is for that property. So what numbers do we put in here for the reverse T formula? I got them right here on the left side. It shows you. So the value is 400,000.
400 on top.
And the gross monthly income, that's the 3,600, goes down the bottom. And 400,000 divided by 3,600, and we get
11 point.
11.
No, can be.
400,000 divided by 3,600.
111.
There you go. 111.11. Okay.
And that's
GRM. Now, is that a good GRM or a bad GRM? See if you're paying attention. There's no such thing as a good GRM or a bad GRM. It's just an insignificant number used to compare two things. We figured out for this property that's getting a 6.6% cap rate in this neighborhood, it's got a 111.11 GRM.
Because GRM, they don't have percentage. They have just
it's a whole number. It's
whole number, right?
Yeah. Yeah. So it's just a number. GRM is just a number used to compare two properties. The number itself isn't good or bad. It's just a number. Now, if we find that another property in the neighborhood comes up for sale, that's also a 3-unit building, but we don't know all the income or expenses on it, we can apply this GRM and guesstimate the monthly income to figure out the price. So here, let's do another problem here. Here's a problem here. It says if a property is for sale for $425,000 with a $9,500 a year taxes, $900 a year insurance, and annual rents of $28,000 a year, and property expenses at $12,500 a year, what's the GRM for this property? First of all, before you start pounding numbers into your calculator, what numbers do you need to figure out the GRM?
So this side is what?
The
Gross
first,
monthly
property
income.
value.
Property
425.
value and
And then the gross monthly income.
which is
We have to calculate.
Annual, 1 minute. Okay. Okay, property sale on 425.
you don't have to calculate anything. The number's already there. Read the problem.
Okay, so we have to.
What is the gross? Gross is income.
28,000. 28,000.
Yep, 28,000. It's income before expenses. So we don't need to know the taxes or the insurance or any other property expenses, they give you that extra information in the problem, which you don't need.
Yeah.
See, this is
Yeah.
why you need to, this is why you need to know what figures you need to put in there, because they may give you extra figures that you really don't need to know. So we plug those numbers in there. You get the 28,000 in annual rent. But to figure out the GRM, do we need the annual income or do we need the monthly income?
The annual
No, the monthly,
or
the
monthly.
gross monthly income. So what do we got to do to figure out the monthly? We got to divide this by 12. And then we get the gross monthly income.
Mhm.
So we can put the value up top as we're figuring out the GRM. The large number goes up top. And then down the bottom, we'll put that gross monthly.
Mhm.
425,000 divided by 2333. And we get the GRM of 182.17. So you just got to remember the T formula and the reverse T formula, they're very handy tools, but you got to remember what numbers go where,
Yeah.
and what numbers you need.
So 182.17, tell me, what does it mean for me? 182.17,
It's just a number used to compare two properties.
or to compare the
So,
property.
so we calculated that this property got a GRM of 182.17 that goes for it goes for 425,000 and the gross monthly income is 2333. Now, this problem didn't tell us how many units there are there or anything like that. So, this problem was just to try to figure out what the GRM is, not to really compare it to two properties, because the GRM, you need to compare it to similar properties, a 2-unit to a 2-unit building, a 3-unit to a 3-unit, a 4-unit to a 4-unit. So this problem doesn't give us enough information here to figure out, to actually use it for a comparison, because it doesn't tell you how many units.
Yeah, and if it is lower or bigger, this mean
It doesn't, the number itself is insignificant. It's just used to compare two properties.
okay.
Okay. Look, here, I'll show you how we could actually put it into practice. In this problem, we're first going to figure out the cap rate on this property, the return on the investor's money, and then we're going to figure out the GRM. And then we're going to compare it to another property that comes on the market. So I already have some figures calculated here for you. The question is, you have an investor that says he'll purchase a property if he could get an 8% return on his investment. That's a lot. Will he get it? And what is the actual cap rate? Well, what do? What do we do here to figure this out?
We have to
figure out the cap rate.
cap rate. Okay, so we have to plug the number first.
Okay, well, what numbers do we need to figure out the cap rate?
Okay, so the cap rate. Mhm. The value of the property?
Okay, this one's selling for 425,000 and it's a 4-unit building. What other number we need to do to figure out the cap rate?
The gross income and then net income.
Well, we need to figure out, wait, which number do we need?
We need to figure out the net income, gross net income.
Well, we need to figure out the net income.
The net income, yeah.
Now, how do we figure out the net income?
We had to add the expenses. I'm sorry, we had to figure out the income less the expenses.
Okay, so it's income minus the expenses.
Mm-hmm.
So we need the monthly or the annual income for figuring out cap rates?
Monthly.
Cap rates is annual.
Oh, cap rate annual. Oh,
Yeah, the GRM is monthly.
oh,
And
yeah.
multiplier. Yep. So the so what figures I already have here? This 4-unit building has 2 3-bedrooms renting for $1,500 a month each, and
Mm,
2 bedrooms renting for $1,200 a month each.
mm,
So 1,500 times 2 units, that's 3,000 for 2 units, and the 2 bedrooms, 1,200 times 2, that's 2,400 for a
mm,
total of $5,400 a month. Times
mm.
it by 12, and you get 64,800 in gross operating income. Okay, so next step, we got to add up all of our expenses, which I've already done here. You can see the total gross operating expenses are 23,520. So what do we do now?
You got to take it off from the income, the gross expense.
Okay, so we subtract the expenses from the income, the
Mhm,
annual expenses from the annual income.
mhm.
So we got to take those annual figures. GOI minus GOE equals the NOI.
Net,
And so we got that 64,800 minus the 23,520 equals the net.
net. Mhm.
Now what do we do?
Yeah. So now we had to, at the top is going to be the property value, 425.
Not for calculating cap rates.
Oh, okay. Oh, sorry. So, and the cap and the left going to is going to be
Yeah, so
the value.
on the bottom you put the value of the property, and on the top goes the annual net income. You
Yeah.
guys got to remember that, otherwise this T formula is not going to help you.
Yeah, now want to work, yeah.
Okay, so here you go. You take the annual net and the property value, and then what is the cap rate on this property?
Yeah, we have to memorize this plug number, yeah.
Mm-hmm. You got to memorize how to use the tool. You can use a
Yeah.
calculator. So I'm not worried about the math. I'm giving you guys a tool on how to calculate these things, how to figure it out.
To use the T, yeah.
Mhm. So how do we use this? What do we do? What's the cap rate on this property?
Oh, how much is going to be?
Yeah.
Oh, uh, let me do 41 to 88. Es sorry, 9.71.
So 9.7% cap rate. Yep.
Mm,
All right, so now let's figure out what is the GRM on this property. So we're going to use the reverse T formula to figure out the GRM for this property. So what figures do we need to know to plug into the reverse T formula for figuring out the GRM?
mhm. For the mm. So it's good. The 425 is going to the top.
Okay, so the large number goes up top,
Mm.
and then what number goes on the bottom? The small number, but what is the small number for the
Yeah.
GRM?
The net operating income, we had to divide it by 12.
No. It's not the net. You're using
Oh,
the
the gross
gross
operating
monthly.
income
64800.
divided by 12.
Okay, hold on. Vimal, I'm just asking at this point. I don't want the answer at this point. I just want you to tell me what numbers we plug in where. I want to make sure you know how to plug in the numbers. The top
420,
goes to
425,000 top.
the value, but what number goes on the bottom? The gross
Five
monthly.
5,400.
$5,400 is the gross monthly income. Will go on the bottom. And then what is the GRM for this property?
78.70.
That's it. But see, the T formula it's an easy tool to make things easy, but you got to remember what numbers go where. If you don't remember what numbers go where, you'll never get these problems right just by randomly typing stuff
Yeah.
in.
We
Like,
have to remember the formula.
because I showed you on a previous question how they throw in all kinds of figures that you don't even need, you know, so because they want to make sure you're not just tapping numbers in, that you remember what numbers you need in order to calculate it. So sometimes they give you problems with extra numbers that you don't even need.
Yeah.
So it's important. I taught you these tools that make it really easy, but you need to remember what numbers you plug in where. So for cap rates, you need the annual net income. And in order to figure out the net income, you need the income, the expenses. You subtract the expenses annually from the income annually, and you get the net. And then that number is the small number that goes on top. Then the value on the other side to figure out the cap rate. And then to figure out the GRM, you use the reverse T formula where the large number, the property value, goes up top, and the gross monthly income, we don't need to know the expenses, goes down the bottom. And then we got the GRM. So this property is going to make this guy a lot of money. 9.7% return on your investment. That's a lot.
Mhm.
You know,
So,
high yield
so
checking accounts, high yield savings accounts aren't even paying that. They're only paying about 4.25% right now, I think. So that's pretty good. That's pretty good. That's double that, you know,
so
more
let
than
me ask you,
yeah.
here in this case, we sell the property for 425 with 4 units with income of. So we have two incomes, right? That means
Well,
we have.
we're talking about an investor wants to buy this property, but only if he makes so much money on this property by holding it and renting it. So how he said that he would buy this property if he gets an 8% return on his investment. So should we recommend that he buy this property?
Of course.
Yeah, because it's a 9.7. It's above 8.
Mm.
Okay. And so the question was, will he get it? And how much is the actual cap rate? So yeah, he will get it. And it's 9.7%. So that means he'll buy this property. So you needed to figure that out to see if this was a property that he would be even interested in purchasing, he or she. Right?
But I didn't get this part. Two to three bedroom units renting 1,500 and two to two bedroom units. So he's comparing these two property, right? I'm lost.
It's one property here. So
One property.
it's a property that sells for they're asking $425,000 for this property. It has 4 units. It has
Okay.
2 3 bedrooms that are renting for $1,500 a month each, and it has 2 2 bedrooms that are renting for $1,200 a month each. These aren't different properties. It's the same property. It's a 4 unit building that has 4 rentals. 2 of them are 3 bedrooms, 2 of them are 2 bedrooms. That's it.
Okay. Okay. It's the same property, but they're having this
Mhm.
two areas too. Okay.
So this is the income we calculated for this one property.
So at that point, the investor is getting back 9.7 from the
That's
from
the
the
rate of
cap.
return. Yep, that's their capitalization rate. And a
Yeah,
cap or capitalization rate, what is that? It's the
9.7.
measurement of the rate of return on an investor's money. What money? Well, the $425,000 he's about to lay out to buy this property.
Yeah. Mhm.
Yeah.
Hmm.
9.7% return on 425,000, that's not a bad deal.
If I win the lottery, so I had to start working with the number, right?
Yeah. Or you buy yourself a 4 family house, you live in 1 unit and you got 3 rental units and you can count the income from the 3 rental units.
Hmm.
All right. Okay. So now let's apply this to another property. We're going to take this GRM. We're going to compare this 4 unit building that has 2 3 bedrooms and 2 2 bedrooms. Remember, the 3 bedrooms are renting for $1,500 and the 2 bedrooms are renting for $1,200. I know rents today have shot up in just a few short years here. So good luck finding them like that around here, right? So now we're going to apply the information from the previous problem to this one. But let's read what I wrote here on the notes up top. Using the reverse T formula and the GRM that we calculated for the other property to figure out how much to offer on this other property now that came up on the market for sale in the same area, we're going to guesstimate it has the approximate same return on the investment from the previous slide without knowing all the exact figures of this property. The GRM is a rough, dirty tool. It's not meant to be exact, but it's one that's meant to get us in the ballpark with the figures that we need to guess on, because we don't know what the rents are on this property or what the expenses are. They didn't share it with us. So can we agree that in the same neighborhood, one 4-unit building should have the same approximate expenses to maintain as another 4-unit building in the same neighborhood? Give or take, they should be roughly the same expenses to maintain those buildings. So we should also be able to agree that a 3-bedroom or a 2-bedroom rental amount in the same area should go for roughly the same amount. It could vary a little bit, but they're going to be roughly in the same ballpark. You're not going to see huge swings in rental, what the rental rate is, So it's not an exact figure. It's not meant to be. It's meant to be a ballpark figure so that we know so we could calculate the details on the property without knowing all the exact figures, and we don't need to go calling up the owner to get all the actual figures that they may want us to sign contracts, these NDAs, these non-disclosure agreements, which before they release their financials to you, before they release what they charge in the rents, like it's a state secret or something. Sometimes they want you to sign a contract that basically says if you ever disclose what the rents are or what their expenses or income are, they could sue you. So why do you even need to get involved in that? Screw them. If they got a 2-bedroom, you know that the 2 bedrooms are renting for approximately $1,200 in this neighborhood, and 3 bedrooms are renting for around $1,500 in this neighborhood. So let's just use that guesstimated figure. We don't need to know the exact numbers, and we can still figure it out. So how much should we offer on this property that came up on the market? It's another 4-unit building that came on the market for sale. To try to get approximately that same 9.7% cap rate that we were getting on that other property. Now, this building is a 4-unit as well. However, it has 3 3-bedrooms and only 1 2-bedroom. So how much should we offer on this one? It's also a 4-unit building, so you can compare 4 units to 4 units. So we know that the 3-bedroom units are renting for approximately $1,500 a month each. So times that by 3, that's $4,500. And then there's only 1 2-bedroom unit, and we know that in this area they're renting for about $1,200. So we're going to apply those figures, even though we're not sure if that's what the rents are from this guy. We're going to guesstimate. We're going to put a little guesstimation into it. So we're going to add up the monthly income there to find out the total gross operating income monthly for this property is $5,700. Now, if this is the reverse T formula, where do we put the monthly income?
And the left under the
On the bottom.
in the bottom, yeah, on the left.
And then what number do we need to fill in here? We need to take that GRM from the previous slide, which was how much? Do you recall?
425. 425?
No, the GRM.
Oh, GRM
Oh,
was
sorry. Yeah, the GRM figure.
Yeah, I believe it was
78, 70? 78.
Let me see. Yeah, 78.70. Okay, there we go.
Mhm.
So We take the 5,700 times the 78.70, which we figured out on the other property in the same neighborhood that's 4-unit building to get us the 9.7% cap rate.
448,590.
That other building, was $425,000. But this building is a little bit different. It has 3 bedrooms and 1 2-bedroom. Okay. But it's still a 4-unit building. So we could apply that GRM to this property. We just calculated by guesstimating the rental figures for this one, because the owner didn't tell us. So how much should we offer on this property to get that same GRM range?
Oh,
You take the gross monthly income, you times it by the GRM that we figured for the other property.
448,590.
448,590. Yeah. It is.
See how this tool can be useful when you don't have any of the figures and we just guessed based on what other buildings are going for in the area, what the rental rates are going for in the other buildings in the area. All right. So the value below is the maximum offer price to get us in the same 9.7% cap rate range as the property on the previous slide in the same neighborhood. Okay. That's a practical use on how to use it. Calculating the GRM is easy. That's all you need to know for exams. So with this problem here, I'm showing you how to actually use it in real life, how it could be useful to you in real life.
If you want to be investor.
Well, you may have investors too that come to you looking for properties. This is a way to find the numbers when you don't have all the figures for this property, but you got them for another property that's for sale in the neighborhood. Then you could just apply those figures to this one and you figured out what the GRM was for that, the cap rate and the GRM was for the other property. So now you take that GRM for that other 4-unit building and you apply it to this 4-unit building to get the how much the offer price. So you should not offer more than 448,590 to get you in that same 9.7% cap rate range. Assuming that the rental rates are the same and the property expenses are in the same ballpark, right?
Yeah.
All right, now we're going to do a different math problem. Here we're going to calculate depreciation. You could use this to calculate appreciation or depreciation. Now, simply reading through these steps here, your head just spins a little bit and you're not going to understand it until we actually do a problem. But let me go through it anyway. Step 1, you determine which method to use, either straight line method or the compound method to figure out the rate of, to figure out appreciation or depreciation math problem. So this is one of the steps, remember, when doing the cost approach. Remember, you got to estimate the value of the land in this neighborhood, put to its highest and best use. Then you need to calculate the cost to construct that building. And then you need to calculate the depreciation on it. So this is one of the steps that the appraiser does in the cost approach. So they got to first determine, are they using the straight line method or the compound method? Straight line method assumes each year's rate of depreciation is a percentage of the original value. So to solve, you multiply the annual percent by the number of years it either appreciated or depreciated. Now, with the compound method, it's more accurate. You calculate the rate of depreciation for each year, doing a separate math problem once for each year. You'll see what I'm talking about when we actually do the math problem. Step 2, are you trying to determine depreciation or appreciation? If something appreciated, you're adding to 100% of what you paid for it, right? If it depreciated, you're subtracting from 100%. Now, you take the rate of depreciation and you subtract it from 100%. Then the next step, Are you trying to figure out how much money the property is worth today, or are you trying to figure out how much you bought it for in the past? To determine past values, you divide. To determine current or future values, you multiply. So, what does that mean? I guess the best way is just to show you in a math problem here. So I've got 4 steps here on the side. We just went over 3 of them. But step 1 is determining value is based on 100%. So this first step is we write down 100% in our notes. Okay. So the question here is if you purchased a property 3 years ago and it depreciated in value 2% per year, and today's value is $400,000, how much did you purchase the property for? And it says to use the straight line method. If the problem doesn't tell you which method to use, straight line or compounding, you're going to use the straight line method. Okay. This problem tells us to use the straight line method. So, are we trying to figure out the value of the property in the current value or past value?
I'm sorry?
According to the problem, are we trying to figure out the current value or the past value of the property?
The current value.
Current value, current value.
Are you? Read the problem again.
Oh, if you purchased 3 years ago, it depreciated today's value. Oh, they are talking about, they are saying that today's value.
Here's the question.
Question is last 3 years back.
Yeah, but this is the scenario, and then it's asking how much did you purchase the property for? So it's looking for a past value.
Yeah, past value.
So it's not looking for a current value. It's looking for a past value. So when trying to calculate a past value, you're going to divide. Okay, so the first step is determining value is based on 100%. So the first step is you got to write down the rate of depreciation. Okay, and what you do using the straight line method is you take the rate of depreciation and times it by the number of years it depreciated, which we got from the problem, and that gives us 6%.
Oh, okay.
So then we take 100% because that's the total value, and we subtract 6% from that. That gives us 94%. Now we take today's value of the property of $400,000 and we divide it, because we're trying to figure out the value in the past, by 0.94. And that's our answer.
Yeah.
Now, if it told us to use the compounding method, we would not multiply the rate of depreciation by the number of years. You just take the rate of depreciation, subtract it from 100%, and then you do the math problem 3 times.
Compound.
You guys hear what I just said?
Yeah.
If you're doing the compounding method, you do not do this shortcut of 2% times the number of years. Instead, you just take the rate of depreciation. You're subtracting it from 100 because if it depreciated, that's subtracting from its value. If it appreciated, you add to its value. So we subtract from its value here 6%. I'm sorry. If it was
2%.
We would subtract the 2% if it was telling you to use
98.
the compounding method.
98.
100, and then we do the math problem 3 times. So we take 400,000 divided by 98%. Okay,
Right.
Get the answer, and then you do the problem again. Get that answer, and you do the problem one more time. So here we're going to do that right now.
392.
Right now.
392.
Well, we'll see. So we're going to answer the same question above using the compounding method. So here you do 100,000. My Zoom controls out of the way. 100,000 minus 2%, that's 0.98 or 98%. And now we take today's value, and we're still trying to figure out a value in the past, how much you purchased it for. So
392,000.
It's 400,000 divided by 98% or 0.98. That's the first year. But you got to do this math problem once for each year. So now you take this figure and then you divide it by 0.98. And then you take this figure and you divide it by 0.98. And you get 424,993. That's the answer.
But I'm getting 392. 400,000 divide 98 is 392. Why? 400,000.
Are you sure you divided it? Well, sorry. Here, I put it back up on screen.
Yeah. Okay. Thank you. Yeah.
So, did you divide or did you multiply?
I did it, but usually
What did you do? Did you divide or did you multiply?
I just do multiply by 0.98.
That's it.
0.98.
Multiply is to figure out the current or future value if it depreciated. So in this problem, we had to divide.
Divide 98.
See, if you're trying to figure out a value in the past, just use a little common sense. You got to slow down, use a little common sense. If today's value is $400,000 and the property depreciated from when you bought it, did you buy it at a higher price?
No.
Listen. If today's value is $400,000 and the property depreciated in value since you bought it, did you buy it at a higher price?
Yes.
Yeah.
Yes.
So the plus value.
So the number that you're calculating then, if you're doing your math right, and this is a way to figure out if you're doing the percentage or the multiplication right.
I got it now.
Your number should be going down. Your number should be going up.
Going up. Yeah.
Because you bought it for a higher price and it depreciated over the last 3 years. So depreciation is a loss of value. So the current value should be lower than what you bought it for if it depreciated. If your numbers are going down, you're doing it wrong. Okay, you're using the multiplication, trying to figure out a future value. Because if I told you today's value, if I told you that you bought the property for $400,000 and it depreciated in value 2% per year for 3 years, what's today's value? Then your number should be going down. Okay, and so you do that by using the multiplication. Okay.
Yeah,
So
I have to remember this is multiply.
Let's do another problem. Let's do another problem.
Mm-hmm.
So look, I got the instructions here on the side telling you what exactly to do.
Yeah.
Now the question is, if you purchased a property 3 years ago and it depreciated in value 2% per year and today's value is $380,000, how much did you purchase the property for?
The past value is gonna be
Which method? Which method?
It says use the compound method.
Compound. Okay, I got you.
So what's our first step? What do we do?
100% minus 2%.
Using the
98%.
compound method, it's 100% minus 2%. Correct. We don't use that
So
shortcut. All right.
And
now
then,
what? Go ahead.
we divided 380,000 divided by 98.
98. Yeah.
So we're going to do that once for each year that it depreciated.
Exactly.
And why are we using division?
Division, yeah.
And why are we dividing?
Because it's this. There are two things I need to remember. This is decreasing. That's why we are dividing.
We're dividing because we're trying to figure out a value in the past.
Value in the past.
See, you divide to figure out a past value. You multiply to figure out a present or future value.
Okay, so first year 387, 755.10. Now.
And that's then the second year.
Divide.
You could just hit you could probably hit the equal sign on your calculator 3 times. The answer.
395.66. Oh, really? Oh.
It works for some calculators, yeah.
Okay. 395.668 as the third year 403.743.
Yeah.
34. Okay.
It's compound.
Mm-hmm.
The math is not difficult. It's just remembering the steps.
Yeah.
That's why I want you guys to remember the steps on how to do this, and I'm not focusing more on the numbers of the math. Math is
Mm.
easy, especially when you got a calculator you could use.
Right, right.
It's just a matter of remembering the formulas and how to figure it out. Okay.
For past value, we have to divide. For current value, we have to multiply.
Correct. So if you purchased the property 3 years ago for 380,000 and it depreciated 2% per year using the compound method, what is it worth today?
Today, so we're gonna do multiply.
So what's our first step here?
So it's gonna be 2 times 1 minute, 2 years, right?
Here, let me read it
2 years.
again. If you purchased a property 3 years ago for 380,000 and it depreciated 2% per year using the compound method, what is it worth today?
Still 98% we're gonna use, but we're gonna do multiply.
So first step is,
100% minus 2.
okay, that gives us 98.
Mhm.
And then we do
380,000 times 98.
And then we do that once for each year. Once, twice, thrice.
You got it. Yeah. 1 minute.
All right. So there's an example when they when they tell you to figure out the value in the past, or they tell you to figure out a current or a future value. All right.
Yeah. I just did the equal sign, and it's coming for 3 years.
Yeah.
That's good. 3
All right. See,
27.
once again, the math is not difficult. It's just remembering the steps.
Yeah, that is true.
And paying attention to what the question's asking of you. Don't rush it. You rush it, you get it wrong.
That's true.
You got 4 hours to take these exams. If the
Oh,
is the difficult part for you, skip them and come back to the math problems later. You can mark them when you're taking the exam. You can mark them to come back to later, so then you could just revisit the marked problems, the ones that you mark. Okay.
current value.
All right. So that's it for that math. Okay. So appraisals are conducted by skilled licensed professionals called appraisers. Appraisers must be licensed. Appraisers charge a fee for appraising. And there's several license types, the 4 types that we went over. Do you recall what they were? Off the top of your head? We had you start off as an apprentice trainee. Then you become a residential appraiser. Then the next step is a certified residential appraiser. And then you become a certified general appraiser.
Mm-hmm.
Which one can appraise residential properties over $1 million?
Yeah, there are 3 things. So it's gonna be the residential or
Which one
general.
Which one can appraise only residential properties up over $1 million?
Only residential.
Certified appraisal.
Which one? There's 2.
Certified.
Well, which certified? There's 2 certified appraisers.
Can be general certified or certified appraisal.
Well, the question was that only residential properties over $1 million. That'd be a certified residential appraiser. Because they can't appraise commercial properties unless they're under the supervision of a certified general appraiser. Okay, so we as real estate agents, we do CMAs or BPOs for valuations, right? CMA or BPO is an estimate of value by a real estate licensee. And we must never, and it must never be called an appraisal or considered as such. As a matter of fact, we even need to write such a disclosure at the bottom of each page of our appraisal. I just did it. Our CMA. We need to also add the remark that every CMA and BPO we conduct. Okay, there we go. I just said that. All right, so why do people get appraisals? On
To
page
get the
317, we got a list of the reasons why people get appraisals. So you may want to write this on the side of there, reasons for appraisal. Because I asked you guys the other day, why do people get appraisals? And I got blank stares. You know, when you buy a property, for financing, the lender's going to want an appraisal of the property. They're not going to lend you more money than it's worth, right? But here, let's go down the list. For estate purposes, to establish taxable value. For divorce proceedings. For financing, to buy something. For taxation reasons. For relocation, when the relocation company may possibly make you an offer on the property to buy it from you so you don't have to put it up on the market and deal with the sale. For condemnation. Condemnation is when a government takes your property using their powers of eminent domain. Condemnation is the taking of that property through the court system, and they need to arrive upon you need to be justly compensated for that property that they're taking. For insurance reasons, for damage or loss, to support income tax deductions, and for feasibility studies. And then they got this thing here. Remember that an appraiser who also appraises FHA properties for FHA loans, those getting FHA loans, it requires that appraiser not only be licensed, but also have a designation on their license that they have to take a designation class to teach them how to do the FHA appraisals, because they want some additional information on those reports. Okay, so the process that the appraiser goes through is they got to state the problem and figure out what's the problem they're trying to figure out, and then list all the data that they need and the sources that for that data that they need to gather, record, and verify that necessary data to determine its highest and best use, estimate the land value, estimate the value by each of the three approaches, which we call reconciliation. So then they reconcile the estimated value, and then they report the final value estimate. So that's the appraisal process. Okay, we don't need to study the appraisal process, so don't worry about that. But what do we call the form that the appraiser uses to do their appraisal on? It's called the Uniform Residential Appraisal Report. Okay, and this appraisal form is required by many governmental agencies. It illustrates the detailed information required of appraisal of residential property. Now, appraisers, they need to take that 15-hour National USPAP course every 2 years, right? So on page 318, Uniform Standards of Professional Appraisal Practice, that's USPAP. That's that 15-hour national course they need to take every 2 years. And you can see on the next page, 319, is the actual sample appraisal report that the appraiser uses, that Uniform Residential Appraisal Report. Okay. What do they call it? The 1004 down the bottom here. You see,
yeah,
Form 1004. So this is the Uniform Residential Appraisal Report. And it looks like the CMA that we were doing, right? When I was showing you how to do a CMA before, how to compare the subject property to comparable 1, comparable 2, comparable 3. But they have a little more information about what is the description of the item that's different, and what's the adjustment they're making for each item, and then they got notes and questions about the market itself. Is it declining market? Is it a steady market, or is it an increasing real estate market? So there's other additional information appraisers need to put on their appraisal reports that we don't put in our CMAs. Okay, so On page 320, MAI is the member of the Appraisal Institute. So appraisers are going to become members of MAI, the Appraiser Institute, and they take a national USPAP course, Uniform Standards of Professional Appraisal Practice, every 2 years, a 15-hour class. It's kind of like the Code of Ethics training class that we as real estate agents take when we're members of NAR. So we're members of NAR, and we take the Code of Ethics training class. All right, now, so New Jersey requires appraisals comply with state standards and be performed by state licensed and certified appraisers. And exceptions allowed in the rare event where a broker's price opinion is acceptable to a lender. The BPO should include a statement including that the report should not be considered the equivalent of an appraisal prepared by a New Jersey licensed or certified real estate appraiser. The statement should appear in print size as large as the main text on the report, so it should not be in fine print. Any fees involved are payable to the agent's broker of record. You get paid through your broker when you do BPOs too. So all real estate appraisals for any purpose must be done by licensed or certified real estate appraisers. The only exception are for CMAs provided to sellers or buyers and BPOs ordered by lenders.
Mm-hmm.
And then they got their little comment down here that real estate salespeople and brokers may get partial experience credit towards appraisal licensing and certification in the performance of a comparative market analysis, CMA. Certification and licensing are handled by the New Jersey Department of Law and Public Safety, which is a division of the Consumer Affairs State Board of Real Estate Appraisers over there on Halsey Street in Newark. And here's their website, njconsumeraffairs.gov/REA for real estate appraising. Okay.
Mm-hmm.
So once again, this is a slide we already went over at the beginning of this chapter, right? You got to start off as an apprentice trainee, then you could graduate up to a licensed residential appraiser who can only appraise residential properties up to $1 million, but not over $1 million. Certified residential appraiser can appraise any value residential property. Correct. And what is considered residential is 1 to 4 units. Anything more than 4 units is commercial. A certified general appraiser can appraise any type of property, residential or commercial. So if a certified residential appraiser wants to become a certified general appraiser, they need to work under a certified general appraiser for at least 2.5 years with at least 3,000 hours of experience in at least 2.5 years. We're doing at least 1,500 hours should be in non-residential appraisals. So doing commercial property appraisals. And then once they become a certified general appraiser, unlike residential appraisers, certified general appraisers have no monetary caps or limitations on the types of the properties that they could appraise either. In any case, all the types of appraiser licenses require they take that 15-hour national USPAP course. Okay.
Mm-hmm.
So,
is it good for exam to remember this stuff?
You need to know that the USPAP or MAI has something to do with the appraisers, and then you'll get the question right on the state exam. I don't know what the question is or how they ask it, but that's how a student told me. They said, oh yeah, I saw something on the exam about USPAP or MAI, and as long as you know it has something to do with appraisers, you'll get it right. So that's the extent of what I know. So I couldn't really tell you what the question is.
Right.
But real estate agents become members of NAR, and appraisers become members of MAI. NAR members must take the Code of Ethics training class every 3 years, and members of MAI must take the 15-hour USPAP course every 2 years. Actually, it's not just members of MAI, it's all licensees. So I'm kind of obfuscating that a little bit, but I'm trying to, just show you that appraisers need to take a class, and I want to show you what it's similar to. Because USPAP, that's their Uniform Standards of Professional Appraisal Practice. It is similar to the Code of Ethics training that we need to take, right? But that's a requirement of their licensing. We as real estate agents, we don't need to be members of the Association of Realtors, and we don't need to take Code of Ethics classes for the association. If we don't take them, it doesn't affect our licenses at all. That only affects our membership in that association. All right. So once again, here I got a slide here that explains it all. MAI's members of the Appraiser Institute. USPAP is the Uniform Standards of Professional Appraisal Practice. It's a 15-hour course all appraisers are required to complete every 2 years. Apprentice trainee is you need to take a 90-hour class and pass an exam. Then you could go to become a licensed residential appraiser, take a 150-hour class and pass another exam, have 2,000 hours of experience over a period of not less than 12 months. And, as an apprentice trainee. And then you can only appraise residential properties up to $1 million. Certified residential appraiser can only appraise residential property with no monetary caps on value, and can appraise commercial property, but only when they're under supervision of a certified general appraiser. They need to take an additional 200 hours of class and 2,500 hours of experience of not less than 2 years to become a certified residential appraiser. Certified general appraiser can appraise any property without any monetary caps, and doesn't matter what style of property it is. So they have to take another 300 hours of approved classes and have 3,000 hours of experience with at least half of it in appraising commercial properties. All right.
Who does only residential licensed residential appraiser, right?
For which one?
Who does only residential appraiser?
The first 3 license types only do residential.
But the certified residential, they do some commercial property also, right?
Under the supervision of a general appraiser.
Okay.
So any of them can do commercial property appraisals if they're under the supervision,
I see,
of a certified general appraiser, because certified general appraiser is the only one that can do commercial property appraisals. Okay. And if any of them want to do appraisals for FHA loans, they're required to complete a special designation class to get that designation on their license, that they know how to do the appraisals for FHA loans. Because they look out for additional things, like they got to look to see if the paint is peeling, if the stairs are loose, or the railings are loose or cracked, or if is there a stove in the kitchen and does it work? If there's a dishwasher, they got to run it through its cycle as an appraiser to make sure it doesn't leak. So there's additional things that normal appraisals don't do that when they're doing it for an FHA loan, they need to do. It's kind of like a little mini home inspection there too. And they have to make notes of these things on their appraisal report. All right, so the profession of appraising is made through membership of these appraisal societies. Appraisals are performed as part of federally related transactions and must comply with state standards and be performed by state licensed or state certified appraisers. We do a CMA. That's a comparative. You guys may want to highlight this about CMAs, BPOs, or just not to highlight it, but to snap a picture of this because it's not in the book. This is a slide I made explaining that we do CMAs as real estate licensees, and we could also do BPOs. And what a CMA and BPO is. A comparative market analysis is used by real estate licensees to help the home sellers and buyers determine the current market value of the property using a sales comparison approach. This is usually complimentary for free. Where BPO, broker's price opinion, is when licensees prepare valuation reports similar to an appraisal for banks. However, we must never call them appraisals. And we usually perform these in exchange for a fee. But remember, that fee must be paid through your broker. And in both cases, whether CMA or BPO, we must contain a mandatory disclosure in a font size no smaller than the average print size on the report, saying that this is not an appraisal and should not be considered the equivalent of one. Or you could add to that, performed by a licensed appraiser, a licensed or certified appraiser. All right, let's add that to that sentence there. If I can find the slide. And then there's a bunch of extra math problems at the end of this chapter. If you want to run them, check them out and do them on your own there.
Yeah.
So we're not going to do these right now. If you want to snap a picture of these, or you could just go into the slideshows later and go through these math problems to get them, cover up the answers and then try to figure them out on your own, using. I got a few questions, then I got compound and straight line methods. Unfortunately, this is not interactive like those other slides were. I just came up with some problems here. And here's another one for you. Give it another go. Before we finish up this chapter, let's see if you guys can figure out the straight line and
Did you
compound
purchase the
method
property for
again.
calculating straight line method
Yeah.
and compound
I'm not going to
method?
help you. Let's see if you could figure
Yeah.
this out without the instructions written here now.
Sure.
Okay. So the question is, you purchased the property 3 years ago, depreciated 2% per year. Today's value is $375,000. How much did you purchase the property for? Calculate it first using the straight line method and then use that compounding method for the same problem. So do the straight line method first and then let me know what you came up with, and then I'll reveal the problem to see if you got it right once both of you are done with the problem here, or the three of you. Okay, Danielle?
Yeah. Straight line. Okay. I think I'm done.
Yeah, I'll give you guys a minute there to figure it out.
How much property? Yeah.
Done.
Okay, got it. So let's see if you're right. What about you, Danielle? Did you work on it at all? Or are you snoozing? Yeah, I got my answer. Okay, so here we go. We started off with 100%. Doing the straight line method, you take the rate of depreciation times it by the number of years. That's 3 times 2 is 6. So we subtract that because it depreciated. We subtracted it from 100, left us with 0.94. So then today's value is 375. We divided that because we're trying to figure out how much we purchased it for. We're trying to find a value in the past. So we divided by 0.94 and we got 398,936. Did you guys get that?
Yes.
And if you didn't, did you figure out why? Okay, that's the important part. If you didn't get it, that's fine. Just as long as you can figure out why you got it wrong. Okay. All right. Now try the compounding method. Remember the compound method?
382.
We don't do the shortcut here. We got.
You have to do it.
Excuse me. And we got
God
to do the
bless
problem once for each year. Thank you.
That's okay.
We got to do the problem once for
God bless
each
you.
year. Yeah.
So 100 minus 2 because it's a 2.
Do 2%, yeah, and then you do it once for each year.
One for each year.
So 382, 653, 390, 462, 398, 430.
So you want to the answer, or you want each by year?
Well, let me know when you got the answer. Yeah.
I got the answer.
I want you guys to work it out. Okay. So then
I have the answer.
there we go.
390, 430.
431. Yeah. So the compound method, it's 100% minus 2 is 0.98. And once again, we're still trying to figure out the value in the past. So we take the today's value divided by 0.98 once, twice, thrice, and we get our answer of 398,431. Correct.
Yeah, the main part we have to remember, if they're talking about past, then we have to do
Past or the current
divide.
value, but you also need to remember when you're going to do this 3 times 2, or you just take
the straight line.
take
Yes.
the rate of depreciation, because that's the two things that are different about it. Okay.
First, by mistake, I did multiply, and I said, no, let me read the question. Oh, that's past value, past purchase price, so then I did divide.
Yeah, you divide to try to figure out a value in the past, you multiply
value in past
to figure out a current or future value. Yeah.
Past value, that's the main important in this is simple than very easy to remember than T formula that I still have to work on.
A lot of people think this is more complicated than the T formula. Okay, well, as long as you remember it.
Yeah, I got the what you no, not the compound. I got the GRM, but the T reverse and that the cap rate still I have to work on one more time
Hmm.
when to use it. Yeah.
Hmm.
Oh, cap rate, capitals. Okay. Now
Right.
what we doing?
Well, now that we're done with that, we do the key terms to review because we're done with this chapter. That's what we're doing.
Oh, wow.
All right, so there are two key terms to review before we get started in them. In key terms 1 on page 322, letter J, at the end of the line, write to compare income producing properties. To compare income producing properties.
1 minute. Key term 2 or 1?
Key terms 1.
Okay.
Next to letter J, you're going to write to compare income producing properties at the end of the line. You're not deleting anything. You're just at the end of letter J, you're writing to compare income producing properties. Yeah.
Okay.
Okay.
And you say in J, right?
Yeah.
Yeah.
Anything else?
No, that's it. That's the only modification. We got that?
Got it, yeah.
All right, then let's get started then. Okay. So, process of estimating value.
Appraisal?
2 is A, it's an appraisal. The rate of return demanded by investors in a particular area. What do we call the rate of return by investors? The return on their investment.
Comparable? Cost approach? No.
What do we call a rate of return on an investor's money?
Capitalization rate.
Cap rate, capitalization rate.
F rate.
So 4 is B. Similar nearby property recently sold.
That called comparable.
That's a comparable. Comp, 5 is C. Extra that contributes to the owner's satisfaction, like clean air, views, and so on.
Oh, extra that contribute to owner satisfaction. Yeah. External. No.
What do we call an extra thing? An extra that contributes to the owner's satisfaction, like clean air, nice views, having a bidet, heated floors, other kinds of things like that. What do we call those?
Functional.
Amenity?
An amenity. 1 is D. It's an amenity. An independent person trained to provide an unbiased estimate or opinion of value.
Appraiser?
3 is E, an appraiser. Analysis of income, including the rental and other factors. Analysis of income, including rental and other factors.
Gross income.
10 is F, the gross income multiplier. A loss of value due to any cause or condition. What is that called when you have a loss of value due to any cause or condition?
Depreciation.
7 is G. A loss of value due to factors beyond the property's boundaries.
Loss of value due to factors beyond. That's a functional ops beyond the property.
Beyond the property's boundaries.
Yes, a loss of value. That's a functional of
A loss of value
yeah.
due to factors that are beyond the property's boundaries. So things that are not on the property.
That's the
External.
external.
External obsolescence. 8 is H. See, you got to analyze these. You got to slow it down. You're rushing too much. You got to slow it down and analyze what they're asking of you.
Due
Be
to
sure
factor
before you answer.
beyond.
Okay? Because once you put down your answer on an exam, you could go back and change it later, but once you put
Yeah,
your
I know.
answer down,
Yeah,
you're going to have to decide on something, they're not going to give you a second chance on that once it's
I know.
so a loss of value due to worn or outmoded, that's like outdated features.
Outdated features. Ah, oh, that's the functional.
Okay. 9 is I, functional obsolescence.
Mhm. In that case, beyond means outside that case. Yeah,
Beyond the
because it's
property's boundaries. It's outside the property boundaries.
right.
Hold on a second, I'm just writing a note here. Okay. Analysis of rental income used roughly in the sales comparison approach to compare income producing properties.
Is that gross rate multiplier?
It is the gross rent multiplier. 11 is J.
J.
An appraisal technique that analyzes the cost to build.
Cost approach.
6 is K. Analysis of value of property using return on investment.
Income approach.
The income approach. And if you want to write underneath that, CAP or GRM. CAP or
Just
GRM. Those are the two methods of calculating the income approach, right? So 13 is L. The use of land that yields the most money.
highest best use.
Highest and best use. 12 is M. All right. Let's do key terms 2. What a property actually sells for.
Market price.
Market price. 1 is A. A loss of value due to wear and tear. What do we call loss of value due to wear and tear?
Physical deterioration.
Physical deterioration. 3 is B. Location and the buyer's willingness to pay more for certain locations. What do we call a buyer's preference for location?
Cities.
Yeah, situs. It's pronounced situs, but I mispronounce it situs because when you find that perfect location, you say, we're going to sit us right here. So situs, situs, however you choose to pronounce it. I use situs because it's easier for me to remember what it is. So 8 is C.
Yes, I like it.
Whatever helps you remember,
Yeah.
Analysis of values received by different appraisal approaches. What do we call it when you use more than one of the 3 appraisal approaches and you apply it to the same property
Self comparison approach.
to figure out which is the best one to value the property?
Reconciliation.
Reconciliation, correct.
Oh, yeah.
A percent worth of present worth, sorry, present worth of future benefits. That could be described as
Reproduction cost.
The present worth of future benefits is described as value. Value. So 11 is E. The cost to rebuild using today's materials and techniques.
Cost to rebuild using. That's a replacement cost.
The replacement cost. You're using today's materials and techniques, so it's not necessarily an exact duplicate. It's the replacement cost. 5 is F. The price that would be paid by an informed buyer. Because maybe we did a CMA for them, so now they're an informed buyer. So what do CMAs help people determine? What do CMAs help people determine, guys?
Sales comparison approach.
Listen
CMA.
for a second. Look up. Look away from the, look away. Just use your
CMA.
brain for a second. Don't look at that paper. Don't look at the paper in front of you. We as real estate agents, we help people determine how much their property is worth doing CMAs. But what value do we help them determine?
Market value.
Market value. What is market value? It's based on supportable evidence of recently sold properties, right? So that's 2 is G, the market value.
Okay.
Appraisal technique that analyzes the sales price of comparable properties.
Sales comparison.
Yeah, it's most often used by real estate agents. An appraisal technique that analyzes sales price of comparable properties.
Sales comparison approach.
Yes, 7 is H. A cost to rebuild exactly using materials like the original.
Reproduction cost.
Substitution.
Reproduction cost.
Reproduction cost. 6 is I. A principle that no one pays more if the same can be had for less.
Subject property.
Subject property.
Wait, what was the answer?
Subject.
Substitution.
Oh,
10 is
principle that
J.
no one pays more if the same can be had for
Yeah,
less.
remember someone else bought a property and then you went to the next one and drove your price up, right?
Okay.
But everybody's going for the cheaper one first. So it's the principle
Yeah.
that no one will pay more if the same can be
Substitution.
had for less. If we have multiple properties exactly the same, people will go for the cheaper one first. A parcel of real estate being appraised.
Yeah, subject property.
It's the subject property. 9 is K. And that concludes chapter 16. So